You've got a good CPA. They file your taxes on time, keep you out of trouble, maybe even save you some money year to year. But here's what people don't realize, and it's costing them big time in retirement. Your CPA might be great at filing your taxes, but totally missing the bigger picture when it comes to retirement tax planning. And it's not because they're doing anything wrong. It's just not what they're trained to do, because most CPAs are focused on what already happened, what you earn, what you spent, and what you can deduct. But when it comes to retirement, the most expensive tax mistakes are the ones that show up years later from decisions you didn't even realize you were making. Hi, I'm Pete Masoni, financial planner with Income Security Associates, and I've seen it too many times. Folks walk into retirement thinking their taxes are handled, only to find out no one was looking ahead. No one warned them about the risk of RMDs. No one showed them how to use Roth conversions in the low-income years. No one explained how Social Security and Medicare premiums can explode if you're not careful. So in this video, I'm breaking down the biggest retirement tax strategies your CPA probably isn't talking about and what to do instead. If you want to keep more of your money in retirement, hit that like button. Please subscribe to the channel and let's get right to it. The CPA's role is backward looking, not forward planning. If we start with a reality check, CPAs are essential. They're great at filing returns, staying compliant with the tax code, and minimizing taxes in current year. But retirement tax planning, that's a whole different game. It's not about this year's refund. It's about how much tax you'll pay on your retirement income over the next 30 years. And most CPAs do not model future income or help you time withdrawals, conversions, or benefits. Here's what they usually don't do. They don't forecast your future tax bracket. They don't coordinate income across multiple accounts. They don't plan for the widow's penalty. They don't navigate required minimum distributions. They don't optimize your Social Security and Medicare timing. Then they won't strategize Roth conversions during low-income years. They're not being negligent. It's just not their job. But if nobody's doing it, you will wind up paying the government far more than you need to. Most common retirement tax opportunities CPAs overlook. Let's break down 5 retirement tax strategies your CPA might be missing and why they matter. 1. Strategic Roth conversions. Most CPAs won't suggest Roth conversions unless you bring it up. But if you're in a lower tax bracket now than you will be later, during RMDs, for example, converting some of your pre-tax dollars to a Roth could save you a fortune. The key is to fill up your tax bracket intentionally before you hit a higher one later in retirement, because CPAs are trained to minimize this year's taxes. They see a Roth conversion as a tax increase, not as a long-term savings opportunity. CPAs won't coordinate withdrawals across account types. A retirement-savvy planner might tell you to tap your taxable account first, then withdraw from your qualified IRAs, 401ks, 403bs, and delay your withdrawals from tax-free savings account or Roths. Why? Because that order affects your marginal tax rate and your Social Security taxation. It affects your Medicare premiums, known as IRMA for Part B, and even age-related credits. But your CPA, they're not building you out a withdrawal strategy. They're just recording what already happened. CPAs helping you to time Social Security, they'll help you file your taxes once you're already drawing Social Security, but few will help you model out whether you should delay benefits to reduce lifetime tax exposure. If you retire at 62 and delay Social Security until 70, you have a tax planning window where you can convert to Roth at lower rates, avoid stacking income too early, reduce future RMDs and taxation of benefits. That timing matters, but it takes forward-looking planning and not just tax prep. Let's talk about the widow's penalty. Most married couples plan based upon their joint income, but when one spouse passes away, the survivor moves into single tax brackets, often with the same income. That means higher effective tax rates and potential Medicare clawbacks. If your CPA isn't helping you plan for this through partial Roth conversions, pension splitting, or strategic life insurance, you could be blindsided later. When it comes to capital gains and income stacking, if you sell an asset in retirement, a rental property, a business, or even a large non-registered investment, that can trigger capital gains. When stacked on top of regular income, it can push you into higher brackets, increase the tax on your Social Security, increase your Medicare Part B premiums. A forward-looking plan can help you space out gains, use capital loss harvesting, or coordinate sales with lower income years. But again, that's not typically a CPA's role. So let's look at a couple of real-life examples. Same income, 2 different tax bills. Let me give you a quick example. Let's say 2 couples both retire at 62 with $1.2 million in pre-tax. Couple A does nothing. They start drawing income from their IRAs needed. They take Social Security at 65. They hit RMDs at 73, pay higher Medicare premiums, and see their marginal tax rate rise over time, especially after one spouse passes away. Couple B works with the retirement planner. They start drawing from their taxable account first. They do their Roth conversion between 62 and 70. They delay Social Security until till 70. They minimize their RMDs, their reduced taxable income in later years, and manage Medicare brackets. Over 30 years, couple A will pay about $400,000 more in taxes than couple B. Same income, same total savings, different strategy. That's the power of coordinated retirement tax planning. So here's the question. If your CPA isn't handling this side of the equation, what should you do? Here's where to start. Step 1. Map out all of your retirement income sources. You need to know where your retirement will come from and when. This includes pre-tax accounts like IRAs and 401ks, after-tax or brokerage accounts, Roth IRAs, Social Security, pensions, rental income, or business income. If you don't have this mapped out year by year, it's almost impossible to plan around taxes. Step 2. Look for your low tax windows. These are years when your income drops temporarily, like after retirement, but before Social Security or RMDs kick in. Those windows are gold. They're the perfect time to do partial Roth conversions, realize capital gains at low tax rates, shift income strategically while your tax bracket is low. And most people miss them because no one is showing them the map. You've got to build a multi-year tax plan, not just this year, not just next year. I'm talking about a 10, 15, or even 20-year plan that takes into account your future RMDs, spousal income and filing status, when you'll claim Social Security, when Medicare starts, the impact of inflation upon your bracket creep. This kind of planning isn't about guessing. It's about running the numbers in advance so you can make smart, proactive moves and not be surprised. Now, coordinate with your team. This is where a lot of people get stuck. They've got a CPA, they've got an investment advisor, but nobody's talking to each other. You need somebody to pull it all together. And that's what I do for my clients. I help connect the dots between retirement income, investment strategy, and tax efficiency so you just don't save money this year, but every year moving forward. And no, that doesn't mean you need to fire your CPA. It just means you need to complement their work with forward-looking planning, because filing your taxes is important, but planning your taxes, especially retirement, is where the real money gets saved. Look, the CPA is not doing anything wrong. They're focused on what they're trained to do, filing accurate returns, staying compliant, and minimizing your taxes for this year. But that's not retirement tax planning. That's tax reporting. If nobody's helping you plan years ahead, you could walk straight into higher tax brackets, Medicare surcharges, tax Social Security, and massive RMD headaches, all because the strategy wasn't in place early enough. This is why I do what I do. I work for people who are close to retirement or already there to build tax-smart retirement income plans that are actually work long-term. Plans that coordinate your withdrawals. Plans that reduce taxes in your 70s and 80s and not just today. Plans that will give you confidence that your money will last and won't get eaten up by the government. So if you're a few years from retirement and wondering, should I be doing Roth conversions right now? When should I take Social Security? How do I avoid the widow's tax penalty or higher Medicare premiums? That's what I help clients figure out. If you want somebody in your corner, somebody who looks forward and not just backwards, schedule below to book a quick call. Let's find out if you're leaving money on the table and, more importantly, what you can do about it. And hey, if this video was helpful, please do me a favor, click like, subscribe, and leave a comment letting me know what stood out to you the most. I appreciate you watching, and I'll see you in the next one.